So hello and welcome. So in this chapter, we are going to cover chapter 3 now. In this chapter, we are going to discuss what are the different investment options that an investor has. So if you are an investor who is looking out to invest, or if you are a portfolio manager handling someone else's capital, then how would you go about it? So rather than going through slides, let us make it a bit interesting. So I'm opening an Excel like we always do. So let us say you have $1 million to invest. So what are your options? Where can you invest this amount, this capital? So we'll start with basics. So the basic option that you have is you can go to a bank. Okay, like 90% of the investors do, we go to a bank. In bank you have your savings account, then you have your current account, also check-in account, also known as check-in account. Then you have your term deposits. Now what are the difference? Check-in account is generally used for transactions, so making transactions from to and fro into the account, we use check-in accounts. Features of checking account: it has zero or very low interest rates, but generally few transactions or all transactions that you do to and fro from the check-in accounts are free. So few free transactions. In certain countries all the transactions that you make from checking account is free, but generally in North America there is a limit of how many free transactions can you make. Okay, so features of a checking account: so it's a recurring or a current account. You can put in money anytime, you can withdraw money anytime, so there is absolutely very low interest rates on it. Second is you would be charged for withdrawing money as well as putting money. So transactions are generally charged. There are few free transactions. In certain countries all the transactions are free. Savings account, little higher interest rate than checking account, so little high in terms of interest rate, but mostly all the transactions that you make from saving accounts has a fee, so mostly no free transactions. Now it depends again on the country you operate in. So mostly there are no free transactions and there is little high interest rates than the current or savings account. Term deposits, you block your money for certain term. So if you withdraw before that term, you would pay some fines, but if you keep the money for the entire term, you generally don't pay fines, and the interest rate depends on how long you hold that money in your account. So you can have a 6-month term deposit or you can have a 5-year term deposit. Generally 6 months term deposit will have lower interest rate than a 5-year term deposit. The reason being, you are blocking your money for a longer duration in a 5-year deposit vis-a-vis a 6-month deposit. So you can pursue this option. So this option is investing your money with the bank, savings account, checking account or current account, or a term deposit. Interest is taxed in most of the countries. That's the another thing you need to feature in. The second is you can invest your money in money markets, so majorly treasury bills. So what are money markets? Money markets are short-term instruments that allow the owners to raise capital for a very short duration. So these are short-term instruments that are used by issuers who issue them for raising money or raising capital for a short duration. Right? Example, a treasury bill enables a government to raise in capital for a short duration from investors. treasury bills or all the money market instruments like commercial papers and other things, so most of them are traded on discounts. So what are traded on discounts? So they generally don't have any coupon or interest payments. So they generally don't pay any regular interest like you get on savings or term deposits, but instead of that, the interest is built into the price. It means they are discounted basis the interest rate and then issued in the market. For example, a gain from money market instrument for you can be investing it at $98 and redeeming it at face value $100. So the gain for you will be $2. You're going to redeem it at $200 when the term ends, and you are currently investing at $98. So the difference between that is the gain. Okay, then you have a wider chunk called as fixed income. Fixed income has bonds and debentures. Okay, so what is a bond? So bond has features of term deposit and money markets. So how it works is, you purchase the bond at certain price. Okay, so let's say $90 in our case, and you redeem the bond at certain price. So let's say it's a 5 years bond, so you redeem it at face value generally. So face value of the bond is majorly $100. So you invested it at $90 and you redeemed it at face value, that is $100. In the interim, it will also pay you interest like it does on term deposit. So it will pay you interest called as coupons. Okay, so let's say $2 is the coupon rate. Now coupons can be monthly, they can be half yearly, or they can be yearly, or whatever term the borrower decides, but generally coupons are half yearly. So most common type of coupon payment is a half yearly coupon payment. So once again, in a bond you invest money, you purchase the bond, right? That is called as the purchase price. Then you redeem the bond. Okay, that is called as the face value. Bonds are redeemed at face value, and in the interim you get coupon rates. Coupon is the interest payment that the bond gives. Coupons are mostly monthly, but they can be yearly, or they are mostly semi-annually, but they can be monthly or yearly also, or quarterly also. Okay, now a bond and debenture has same working. So debenture also has a purchase price, it also has coupons, and it also has face value generally. Okay, but the difference is bonds are secured by assets and debentures are secured by residual claim. So what is difference? So there are particular assets that the company highlights, or means company collaterals, means there are particular assets that the company put as collaterals with the issuing bank or with the issuing authority. So if you are not paid as a bondholder, you have rights on those assets, you have the first claim on those assets. As a debenture holder, you have residual claim. So once the bondholders are paid, then whatever is left, it comes to you. So you have residual claims. Bondholders direct have a direct claims. So bonds are secured by assets, debentures are secured by residual claims. Okay, now there are certain variations of bond, like or debentures. You can have a zero coupon bond. So in a zero coupon bond, there are no interest payments. Okay, so only gain that you make is difference between purchase price and the face value. Then you have convertible bonds. That is, for a certain point they pay you interest like a bond does, and later on they can be converted into equity. Then you have a floating rate bond. So floating rate bond means the interest readjusts based on the interest rate in the market. Okay, so coupon rates are not fixed. Coupon rates fluctuate as the interest rate fluctuates. So if interest rates are going up, the coupon goes up. If the interest rates are going down, the coupon goes down. Then there is inflation adjusted bond, so in which it pays coupon as a proportion of inflation. So if the inflation goes up, the face value goes up and the coupon goes up. If the inflation goes down, the face value goes down and the coupon goes down. So the face value is adjusted basis on the inflation. Okay, then you have equity. In equity you have preference and you have common. So what is preference shares? So they are a marriage between bond and equity. So they are the means offsprings of bond and equity. So what is a preference shares? It generally has a fixed coupon, a fixed dividend, not coupon, fixed dividend like a bond. Okay, but it has certain advantages of equity, right? The advantages or certain features of equity rather than advantages. There are the certain features include dividends are not compulsory to pay, right? So if you don't make any profits, there is no dividend, so dividends are not compulsory to pay. And another difference between preference shares and common equity, these shares have preference over common equity in dividend as well as liquidation. So when the company is liquidated, first of all preference dividend have to be paid, then any proceeds go to equity holders. Same way, when a dividend is declared, first preference dividends are paid, later on if anything is left, then it goes to common equity holders. Okay, so they have preference in terms of dividends also and in terms of liquidation also. Now common share, it's a very exciting thing. So you become partners in the firm. Whenever you invest, you are becoming owners or partners in the firm. Okay, your ownership is the proportional shares that you have. So if there are 100 shares and I have one share, there are 100 shares that the company has and I have one share out of it, so I'm 1% owner of that company, right? Now as a owners, you have right to dividends when the company declares them. You have right to, your profits belongs to the shareholders. So company's entire company's profits after paying everyone else, it belongs to the shareholder. And whenever it is liquidated, whatever is left after paying everyone else, it belongs to the owners. Also you have certain rights like voting. So you can vote in annual general meetings and decide the board of directors. So you can have a say in how the company works and what are the future plans and whatever decisions it is making. So as a common share, you are becoming a partner. Whenever you invest, you get dividends if the company declares them. You get profits, so whatever profits are left after paying everyone else, they belong to you. You get liquidation, that is when the company is wound down, it is closed. If everyone else is paid, whatever is remaining, it belongs to you. And you get voting rights. Common shares generally make money in shares in two ways: through dividends, that is share of profit that the company declares to pay out in cash to the shareholders, and the share price appreciation. So invest at $10, the company is small, the company goes big, it becomes $100 investment, you sell it off, the difference is your capital gain. Okay, generally in North America common shares are taxed, but in certain countries investment in common shares are not taxed. In North America or in specifically Canada, the taxes are 50%. So whatever gains that you make in capital gains, you have to pay 50% of tax on it. So just to recap, we have seen wherever, if I give you $1 million, where can you put it? You can put it in a bank, in a savings account, current account, term deposit. Then you can put in a fixed income instrument, a bond or debenture, right? So bond and debenture, we have seen it appreciates in price, as well as, means there is a difference between purchase price and the fixed income, means the face value. It can appreciate or it can depreciate. So certain bonds may be issued at $110, and the face value is 100, so you buy it at 110 and you receive $100. So there is depreciation in the bond price, or there is decrease in the bond price. These bonds are called as issued at discount, these bonds are called as issued at premium. Okay, then you have debentures, exactly same like bond, difference secured by residual claim instead of secured by assets. Then you have preference shares, marriage between bonds and equity. So you have fixed dividends, and you have preference in terms of dividends and in terms of liquidation over other players. And then you have common shares, you are becoming a owner of a company, you have rights to dividends when they pay it, you have profits claim, you have liquidation rights, you have voting rights, right? And you make money by increase in share price, that is capital appreciation, as well as dividend. So other thing that you can invest in is options, is derivatives, not options, is derivatives. So we'll be discussing about derivatives in the next class. Thank you for your participation. Have a nice day, stay warm, have a nice time.